There are two main fears in the real estate market right now, and in this video, I'm going to tackle the first, and that is about whether or not home prices are going to crash. As you can see from this graph, which is a survey held every December about whether or not people think that home prices are going to come down over the next 12 months. Well, as you can see from this bar, big red bar on the right here, at the end of 22, 37% of Americans thought that home prices would come down over the next 12 months. And currently, 24% of Americans, meaning almost 1 in 4 Americans, believe that home prices are going to depreciate, which is wild because we've seen such staggering growth over the last 3 years and continue to, even when things have gone up and down. I can show you in this slide from my brokerage's year-over-year report that in Los Angeles County, we are up 1.1% in the median price point from $930,000 in July of 22 to $940,000 in July of 23. But you can also see that we went down to about $840 and then up to $880 and then up again to the $940 we're currently at. So just in a year, yeah, we went over a little roller coaster ride, but we're higher than we were last year. So what's driving people to think that home prices are going to depreciate when all they've done is go up over the last 3 years? Well, at the end of 2022, you had headlines like this: a 20% home price decline. This is from Fortune magazine, December 7th of 2022. The media hyped up what we were seeing in that quarter specifically, which was a deceleration of appreciation, which I'll get into later, and a correction of sorts from how aggressive things were in 21 and the beginning of 22. So when you put out a headline like this, and this was just one of many, what happens? Well, you can see from this chart, this is the consumer confidence in home price rates, right? So it's the percent who believe home prices will go down in the next 12 months. If you look at the right side of the chart, you have talk of the repeat of a 2008 style crash. Now, 2008 crash was a real estate driven crash. We crashed the economy because of things that were directly related to the way that we were writing loans and handling real estate transactions, none of which is currently true. That's ridiculous. We're not anywhere near it. And I'll show you from the rest of these slides why that comparison is wildly inaccurate. So let's take a look at listings. We're looking at 2017, 18, 19, and 2022. So in 2022, right about here in June, the media is saying, oh, the market's going to halt and corrections coming and listings are going to go through the roof because everybody needs to get out and everyone's scared of the market crashing and they want to get out and they're just going to go rent. Well, this was the projection, the dotted line, that new listings are going to go up and to the right. But what actually happened? Well, as you can see here, rather than going up and to the right, they went sharply down and to the right. We're talking about the lowest level of new listings they've ever been. In December of 2022, listings were down 21% year over year. So what actually happened in 2022 when previous to the December, doom and gloom headlines that the market was going to crash heading into 23? Well, to understand exactly what happened, let's go back and look at the 48-year average of monthly price movement, okay? This is from 1973 into 2021. These are the average monthly price movements, meaning it went up 0.12% in January and as much as 0.88% month over month in May. So from the previous year to the current year. And then it tapers off, and this is the general trend. You'll see a home appreciate about 0.12% in January, a quarter point in February, nearly 2/3 of a point in March, so on and so forth as you make your way through the graph. I'm going to show you right now what the 48-year average is versus 2022 price movement. So instead of a typical 48-year average of 0.1% growth month over month in January, in 2022, January had a 1.1% month over month growth. 1.9 in February, 2.6 in March, 2.3 in April, and 1.5% in May. Let's just look at March for a second. That is over 4 times the average price movement positively in a month. That's not sustainable. It wasn't sustainable when we were having 20, 30, 40, 72 offers on properties during the later half of 2020 and 2021, when homes were selling for astronomical numbers above where the actual air quote value is for that home. There has to be a correction. There has to be a moment where things kind of settle out and go, okay, this is too much, it's unsustainable. And that's what happened at the end of 2022. And that's what kicked off the media circus about the market crashing and everything's going to go to hell in a handbasket. In July, it started to go down. And then it went down in August, and it went down in September, and it went down in October, and November, and December. But here's the thing. That corrected, that leveled off. It was the same, it comes out in the wash, where you have a wild increase in the beginning of the year, and you taper it back and tamp it down in the second half of the year. So how does that play into what happened in 2023? Well, let's look at the 48-year average versus the 22 and 23 price movement. We know that the 48-year average in January was 0.1% typically. In 2022, it was 1.1%, and in 23, it was down 0.5%. But what happened in February? Well, in February, we were up 0.2%, close to the average. In March, we doubled the average at 1.3%. In April, we nearly doubled the average at 1.5%. And in May, we were up between 25 and 33% to 1.2. So we corrected ourselves at the end of 22 from the wild appreciation that we had seen at the beginning half of the year, and then tapered off towards the end of the year. And that's what caused everybody in the media to lose their minds and say the market's going to crash. And some pretty prominent people say, oh, there's going to be a 15 or 20% correction coming. And that just didn't happen. You need to make sure you understand this. Deceleration of appreciation is not the same as depreciation. If I'm going 50 miles an hour and I hit a hill and I'm now going 45 miles an hour, I'm not going backwards. I'm just going up slower than I was before. And that's what happened. That's not the picture that the media painted. But let's look at the percentage of annual home appreciation from 1980 to 2022. Well, you can see that the 42-year average home appreciation is 4.92%. That means that on average, every year, your home is going to appreciate 4.92%. You can see that the down red bars are the crash, the Great Recession, that was built on bad real estate transactions and deals, bad mortgages, and otherwise that was a real estate created crash. And since then, you can see that we have been almost at or above the 42-year average every year since we got out of the Great Recession. So what does that all mean? It means that this real estate market, contrary to what a lot of investors and a lot of smart people think, is continuing to appreciate. And that's partly due to the fact that we have way less homes available for sale than we've ever had before, and way more buyers in the market ready, willing, and able to pull the trigger on a competitively priced home in a competitive offer situation for over the list price that are well qualified. And that well qualified component is the big difference between this market and the comparison to 2008, where you could have gotten a house. In 2008, you could have been paid to buy a house, meaning right now you need to have at least 3.5% to 5% for a conventional or FHA mortgage, and typically somewhere around 15 to 20% for the purchase of a home. That means that your mortgage is going to be anywhere from 96.5% for an FHA to whatever the residual is between your down payment and the price of the home. In 2008, they were writing mortgages at 105% the value of the home, meaning you put no money down. They actually paid you 5% to buy the home, which means that when you walk in to your home, you are already underwater. You have zero equity. You actually have negative equity because the bank paid you to take the home. We're not there. The amount of equity in the market right now is staggeringly high, And if you want more information on it, then please check out the next video that I'm going to do tackling fear number 2 of the market. Every day I have people hit me up with questions about whether now's the right time to buy or sell or invest or build or whatever it is. And I love having those conversations with people. My information is on the screen right now. Send me a text. It's really me. It's not a bot. It goes straight to me. I'd love to have the conversation with you. If you are curious about what your home could be worth right now, I love doing, market reports for folks that reach out to me about what their home may be worth, and helping people understand what the lay of the land is moving forward. The same number of people that believe home prices are going to go down is actually the same number of people that were surveyed and said that they were planning on either listing or planning on listing their home in the next 36 months. So interesting market dynamic there. If you fall into that latter category of either currently wanting to list or listing in the next 3 years, and you want to have an understanding of how much your home may be worth, what to do to it, how you can increase the value of it now, later, or at the point of sale, I am here to have those conversations. Don't have fear, have facts. I'm here to help you understand the market conditions. And I will leave you with this last little tidbit. Anybody tells you that they know what's going to happen to mortgage, they're full of crap. No one has any idea, not even the people that are in charge of mortgage right now. What everybody will tell you, and it's cliche and ridiculous, is the right time to buy a home is when you have the money and you find the home. Be prepared for mortgage to probably be closer to 9 than 6 over the next, few months, definitely few months to a couple years. But buy a home when it makes sense for you financially, you find the home that you want, and you are working with a professional to understand how that home works for your life. I appreciate you taking the time to watch this video. Drop a comment and let me know what you thought, but really more importantly, shoot me a text. Let me know what you thought. Let me know what questions you have. I look forward to seeing you on the next video.